Did that happen during the video?
Do it again.
Hey, what's up guys? It's the Average Joe here. In this video, part 3 of my Forex for Beginners series, I will be providing you with an introduction to understanding Japanese candlesticks, as well as explain to you guys the trading process. If you have not yet watched part 1 and 2 of the series, I highly recommend you go and watch it. And the links for the videos will be in the description below. Also, if you enjoyed today's video, please remember to like and subscribe, as it really helps out my channel. But anyways, let's get right in. First, let's talk about Japanese candlesticks. Japanese candlesticks measure price movements over a given period of time and are found on all charts of all time frames. For example, if you are looking at a 1-hour chart, then each candlestick represents 1 hour of price movement. There are also 2 types of Japanese candlesticks. You get a bullish Japanese candlestick and a bearish Japanese candlestick. On a chart, bullish Japanese candlesticks are usually white in color and they indicate that the market is moving up. Bearish candlesticks are usually dark in color and indicate that the market is moving down. Each candlestick consists of 4 basic parts, which shows the market's open, high, low, and close price for a given time frame. The wide part of the candlestick is referred to as a body or a real body. The narrow parts above and below the candlestick body are referred to as the wicks of the candlestick. Traders can use candlesticks to identify patterns of price movements, and when candlesticks occur in certain formations, they provide you with an indication that the market will most likely go up or down, hence giving you a signal to either buy or sell. But we will speak more about candlestick formations in another video. In terms of market movement, the Forex can essentially only do 3 things. It can go up, it can go down, or it can go sideways. The sideways movement, which we refer to as consolidation, is actually participating in either upward price movement or downward price movement in the market, which brings us down to the fact that the market can only move up or down. Now let's have a look at the trading process. On the Forex, you are able to execute 2 different types of transactions, a buy-sell or a sell-buy transaction. When you execute a buy-sell transaction, you are referred to as being a bull. A bull is an individual that enters the market buying first and exits selling second. You are anticipating that the market will go up. The term we use when the market goes up is called a rally, and the position you are taking is long or bullish. If you buy first, you will need to come out selling second at a higher price to make a profit. Bulls buy low and sell high. As I highlighted in the first video, a Forex trader can make just as much money as the market comes down as they did when the market went up. When you execute a sell-buy transaction, you are referred to as being a bear. A bear is an individual that enters the market selling first and exits buying second. You are anticipating that the market will go down. The term we use when the market moves down is called dipping, and your position is short or bearish. If you sell first, you will need to come out buying at a lower price to make a profit. Bears sell high and buy low. I like to give this analogy that trading is like an auction. There are buyers and sellers. Sellers are asking for a high price because you want to sell something for as much as possible. This higher price is called the ask. When you are buying, you buy at the ask price. Buyers are bidding at a lower price because you want to buy something for as cheap as possible. The lower price is called the bid. When you are selling, you sell at the bid price. The difference between the bid and the ask price is called the spread. The spread would go to the auctioneer, or in our case, it would go to the broker managing the transaction. The spread is the transaction fee for the trade. In general, on the Forex market, major currency pairs tend to have lower spreads. Now let's look at types of orders. For each individual trade, we will place 3 types of orders. 1 order to enter the market, called a market order, and 2 possible orders to exit the market, which are called a limit order and a stop order. Let's first speak about a market order. A market order is an instruction from a trader to their broker to execute a trade immediately at the best available price in the current market. It is literally the price at which you enter the trade either buying first or selling first. Now let's speak about a limit order. A limit order is an order placed to exit the market when the market reaches a specific price. It is also referred to as your take profit, meaning if the trade is going in the direction which you anticipated, it will take you out the market and secure the profit which you have made. Lastly, let's talk about a stop order. A stop order is an order placed to exit the market when the market reaches a specific price. It is also referred to as your stop loss. And as the name implies, stop orders stop your losses. It is a protective order, meaning if the trade is not going in the direction which you anticipated, it will limit the amount of money you can potentially lose on that given trade. Now that we have spoken about the three types of orders, let's see how they look on a chart. In example 1, we are anticipating that the market will go up. We are entering the market buying first and selling second. We are taking up a bullish position. If you buy first, you will need to come out selling at a higher price to make a profit. The purple line is our market order. It is our entry buying in the market. The red line is our stop order. It is stopping our potential loss. Remember, we are anticipating that the market will move up, but let's say that the market came down instead. This stop order will pull us out of the market and limit the amount of money which we lose on the trade. The blue line is our limit order. It will limit the amount of profit we make on the trade. If the market reaches this price, the order will be executed for us to exit selling on this trade and secure the profit which we have made. In summary, every buy entry should have two sell exits. One exit sell for profit, called our limit order, and one exit sell for a loss, called our stop order. In example 2, we are anticipating that the market will go down. We are entering the market selling first and buying second. We are taking up a bearish position. If you sell first, you will need to come out buying at a lower price to make a profit. The purple line is our market order. It is our entry selling in the market. The red line is our stop order. It is stopping our potential loss. Remember, we are anticipating that the market will move down. But let's say that the market moved up instead. This stop order will pull us out of the market and limit the amount of money which we lose on the trade. The blue line is our limit order. It will limit the amount of profit we make on the trade. If the market reaches this price, the order will be executed for us to exit buying on this trade and secure the profit which we have made. In summary, every sell entry should have two buy exits. One exit buy for profit, called our limit order, and one exit buy for a loss, called our stop order. Something important to note is that only the limit order or stop loss order will be executed as your exit from the market, not both. And the order which is executed depends on which price the market reaches first, either the limit order or the stop order. Alright guys, that's going to do it for today's video. Once again, if you enjoyed today's video, please remember to like and subscribe. The next video in the series will be out next Wednesday. Until then, stay safe and strive to be more than average.